So I've been seeing a lot of trading gurus on YouTube teaching people how to trade and baiting them into making quick and easy money. And sadly, some of my friends have been baited into this. But I've been trying to meaning to tell them that the thing is, real edge when you trade don't stay real for long when it goes public. So back in the late 80s, Morgan Stanley reportedly made tons of money from something called pairs trading. Basically, a few strategy, only a few people knew how to do back then. But once that idea spread, other firms copied it instantly and more money piled into the same trades, and the advantages that Morgan Stanley had got crowded and faded away. And that, quite honestly, is the true form of markets. If there is an obvious free money strategy, people will rush in, the price adjusts, and the opportunity disappears. So, in other words, every time someone trades an edge, they're actually pushing the market towards efficiency and making it flatline. And that is where most retail trading content gets misleading. Many strategies look amazing in back seats because they ignore real world costs like fees and slippage. But in actual markets, especially high liquid ones, any small edge gets competed away extremely quickly. And that is why I'm doing this project differently in the first place. So instead of copying some guru strategy like TJR or something like that, I'm going to start from step zero, getting data, build features, test real models, and measure it against buy and holds. And for this video, I'm testing a real quant idea of, can we detect market regimes using Markov chain models and use that to allocate our money across ETFs over time instead of just buying and holding?
So this project looks at how market move through different macro environments and how we can structure risks around that. So instead of trying to predict returns directly, I built a simple regime switching framework that adjusts the allocation based on changing macro conditions. So the main questions that I'm asking are, do returns behave differently across macro environments? Do the environments exhibit persistence and can probability improve upon reactive allocation? So my goal isn't really to maximize the returns at all costs. It's more of to reduce the drawdowns while still participating in the upside. So the framework here is that this is the structure of the model. So first, I used a model data from 2005 to 2025 of ETFs with inflation, real rates, and liquidity conditions. Then the model estimates which regimes were most likely in and the probability of transitioning to the other regimes. Finally, the allocation adjusts based on those probabilities. It then recalculates every month automatically. I'm not manually switching states. The weights are driven entirely by the model's probability output. So, using Markov's chain. So, a Markov's chain assumes that this happens next depending only on where we are right now, not the entire market history. So, instead of remembering the entire market history, the model only needs to know the current market conditions to estimate what comes next. That simplifies extremely of the structure while we're still capturing the persistence of the markets. So we're turning the markets as states into the Markov chains. So markets move between different macro conditions. So I labeled them risk on, stable expansion, and risk off. So the important part is that we can't directly observe the regime, but we can only see the macro data and market behavior. And from that, the model infers the hidden state. So the hidden state using hidden Markov models. So this is where that hidden part comes in. So what we observe is macro data and market indicators. What we don't observe is the true underlying regime. So the market uses the observed data to estimate monthly regime probabilities. Then allocation is weighed by those probabilities. So instead of fully switching between bull and bear, the portfolio actually adjusts itself gradually based on how confident the model is. Now I'll walk through the logic behind the code. So first, I loaded the ETF data from 2005 to 2025. I used five different ETFs, which included SPY, QQQ, IWM, TLT, and GLD. So each one has daily price data. I used the adjusted close, so dividends are included. And then I converted the daily prices into monthly prices and calculated the monthly returns. So at that point, I know how much ETF moves every month from 2005 to 2025. Next, I built what the model actually looks at. The model only sees two things. So SPY's monthly return and SPY's 12-month rolling volatility, and that's it. So each month it sees how SPY performed and how unstable it's been recently. So it doesn't see the label, it doesn't see the future, but it just see those two signals. Then I fit a hidden Markov model. The model looks at the history and separates it into three hidden environments. So it just finds patterns in the data and then putting labels on top of it. So after it separates them, I interpreted them based on behavior. Risk on means strong returns, higher volatility. Neutral means moderate returns, lower volatility. Risk off means weaker returns and elevated volatility. So the labels comes after the model finds the structure. So the model also learns persistence. When we're in one state, how likely are we to stay there next month? That's where my transition matrix tells me. So it's basically just a summary of past behavior. For example, if the markets are calm, they tend to stay calm. So the most important part is that each month the model outputs probabilities. For example, 70% risk on, 20% neutral, 10% risk off. But if I use those probabilities in the same month, that would be cheating because those probabilities are calculated using that month's return. So I shift them back to 1 month. That means when I invest in March, I only use the probabilities calculated from February. So every allocation decision only uses information that was available at that time. So instead of looking ahead. Now for the allocation. Even though I brought in 5 ETFs, it is important to understand that the allocation itself is only between SPY stocks and TLT, long-term bonds. So SPY represents broad equity risk, and TLT represents defensive exposure. The regime signal is built from SPY's behavior, so the allocation becomes a simple equity versus bond rotation. So the other ETFs, QQQ, IWM, and GLD, are used for comparison, not for the allocation. So I kept the structure simple on purpose to avoid overfitting and kept the signal interpretable. So the allocation rules are simple. If risks are on, I put 100% of the money in SPY. If it's neutral, then 70% in SPY and 30% TLT. But if risk is off, I put 20% in SPY and 80% TLT instead of hard switching from one after another. So if the model says 70% risk on and 30% chance neutral, I blend those weights. So the allocation becomes a weighted mix based on the confidence level that I have that month. So it actually adjusts gradually instead of jumping between extremes. So once the weights are set, the portfolio return is simple. The weight in SPY times SPY return plus the weight in TLT times TLT return. So that gives a strategy return for the month. Then I repeat the process every month from 2005 to 2025. Update the probabilities, shift them, set new weights, calculate them over and over and over. And finally, I evaluate the performance. I calculate the CAGR, the Sharpe ratio, and maximum drawdowns. Then I compare the strategy against SPY, QQQ, IWM, TLT, and GLD. And then I plot everything onto an equity curve. Now looking at the results. The chart shows the equity curves from 2005 to 2025. The blue line is the Markov strategy that I made. The other are the ETFs that I brought in. The first thing to notice is that the strategy does not beat the QQQ at all. It massively outperforms everything over this period. And that makes sense because this was such a growth dominated environment. So this model is not trying to chase the momentum or maximize the raw returns. But now look at the SPY. Although SPY ends higher than the strategy in total returns, however, the drawdowns in 2008 and 2020, the strategy falls significantly less than SPY. The maximum drawdowns for the strategy is about 30%, and SPY is about 50%. So there's actually a meaningful difference. So what this model is really doing is actually smoothing the ride instead of falling down with the SPY. So it sacrifices some upsides during the strong bull markets, but it reduces the downside risk during the stress period. So now look at the Sharpe ratio. The strategy's Sharpe ratio is about 0.80. So SPY's is about 0.74. So the risk adjusted, the strategy is actually performs better. So that's actually super interesting. So I found out that this is not really a maximization profit engine. So instead, it kind of behaves more like a systematic risk management overlay. So it adjusts exposure based on market environments instead of staying fully invested all the time. And if you look at the average weights, the strategy is about 63% SPY and 37% TLT over the full sample. So structurally, it's actually a defensive and a decent amount of time. So this explains the lower CAGR, but also the lower drawdowns. And to fully sum this up, the model doesn't try to predict massive rallies or beat tech during the long bull runs, but it reacts to changing market regimes and adjusts risk to navigate different environments more smoothly.